Hello students, this is CA Pragnesh Kanabar, and I know that there is some anxiety in your heart and mind regarding the exams, and especially this particular topic, audit of NBFC, is giving you big time headache. But don't worry, we are here and I will ensure that the entire topic as amended from May 25 attempt onwards is there in your mind. All right. First of all, please do one thing. Please download these notes from my Telegram channel. Link is given in the description of this particular video, and I have uploaded it as audit of NBFC BRAHMASTRA notes, which you will see the PDF. This video is going to be in English because I'm shooting this very near to the exams and I don't have the time for both English and English version. So I want even my South India students to understand. That's why this video will be in simple English so that everyone can understand. Okay. Now, when you look at audit of NBFC topic, first please understand one thing. There are total 7 points. 1, 2, 3, 4, 5, 6, and 7. All right. So total there are 7 points that should be there in your mind. As simple as that. I hope that makes you feel better. Chalo. Now the very first point. Definition of NBFC. Everyone understands NBFC is an institution or a company whose main business is receiving of deposits and lending in any manner. That is a simple definition which I have given over here, which you can just go through once. However, the most important part of the definition is the 50-50 rule, which is given by RBI. It is straight away connected with clause 16 of CARO 2020. Now listen to me very carefully. You will have to check the last audited financial statements of the company. You will have to see whether it fulfills two conditions. First, whether financial assets are more than 50% of the total assets minus intangible assets, and income from financial assets is more than 50% of the gross income. First and second, all right, if both of these conditions are fulfilled, then that particular company will classify as NBFC. Sir, financial assets, loans and advances, investments. Sir, income from financial assets, that is your interest income, dividend income and stuff. All right, you will have to check the last audited financial statements and then straight away read clause 16A of CARO 2020. So this becomes one of their favorite case study. Whether the company is required to be registered under section 45A of RBI Act 1934, and if so, whether the registration has been obtained. So that is why they will give you a case study. My dear students, there are 3-4 questions based upon this in the module. But the question which is given clearly with the calculation is the last question, which talks about Singh Limited, and which is there in the second last page of this particular PDF. So please pause this video and solve the question ASAP. All right. Now, there is a list of companies exempted from registration. Let me be very clear that these are the companies which actually satisfy the 50-50 rule. However, they are regulated by other regulators. That is why they are in the exemption list. That means there is no need to obtain registration from RBI. However, the most critical from this list is core investment company. What is a core investment company? Core investment company is a company which will invest in a particular group. All right. For example, if I'm investing all my assets in Tata, only Tata, then I'm a core investment company. So best example of core investment company is Tata Sons, which is investing in various companies of Tata. Okay. Technically, the criteria is that more than 90% of the total assets of Tata Sons should be invested in the Tata group. Sir, but why you are teaching core investment company in detail? Now, when it comes to core investment company, there is a exemption from the registration. Sir, can you please explain? In a core investment company, we will have to look at the asset size. If asset size is less than rupees 100 crores, then it is exempt from registration. That means there is no need to obtain registration. However, if the asset size is 100 crores or more, all right, if asset size is 100 crores or more, then you have to please pay attention over here. There are two possibilities. Either the company is accessing public funds or the company is not accessing public funds. If the company is accessing public funds, then it will have to register. So if the asset size is 200 crores, they will have to register if the company is accessing public funds. But even if the asset size is 800 crores and they are not accessing public funds, then it is exempt from registration. All right. See, let me tell you, in NBFC, the most difficult thing is to make the notes, which I have done. Now I am just running you through the notes, so you can pause and go through it and just move ahead. All right. And that will ensure your finest preparation. Now, if you read clause 16B to 16D of CARO 2020, you will understand. All right, that how it is deeply connected over here. 16A talks about whether the company is required to be registered, 50-50 rule. 16B says that if the company is required to be registered, whether without registration they have performed any kind of NBFC activities. All right. So A and B is all about registration requirements. C and D is all about core investment company. They are asking whether company is a core investment company. All right. Whether if it is exempt from registration, asset size less than 100 crore or more, not accessing public funds. All right. Then whether the company continues to fulfill the criteria of exemption from registration. Okay. And then 16D is just asking you whether there are more than one core investment companies as a part of the group. Now we move to the next part, that is types of NBFC, which is again very, very critical. There are three different ways in which NBFC can be classified. First, either NBFC is taking deposits from the public, then it is NBFC D, or it is not accepting, not taking deposits from the public, then it is NBFC ND. So NBFC D, NBFC ND. Second way of classifying NBFC is based upon its main activity. All right. I will just quickly run through investment credit company, which is into mostly loans and investments. Infrastructure finance company, which is into infrastructure finance. Core investment company, again maximum investments are in a particular group. Then infrastructure debt fund. So what is this infrastructure debt fund? It will issue infra bonds to the public and get the money. All right. Then NBFC microfinance institution for financing semi-urban and rural borrowers. All right. NBFC factors, acquiring the trade receivables, that is the business of NBFC factors. NOFHC, non-operative financial holding company. All right. For example, if Reliance promoters want to start Reliance Bank, then straight away they cannot start Reliance Bank. They will have to create Reliance NOFHC, transfer money to that, and Reliance NOFHC will hold Reliance Bank. So it is created specifically to hold banks on behalf of the promoters. And then they give us some etc category of NBFCs. Now, third and the most important way of classifying NBFC is a scale-based regulation. All right. That means all the NBFCs are either classified into base layer, middle layer, upper layer, or top layer. Now, these notes are extremely important for you. Very, very important. You have to stay focused for the next few minutes. Let me explain first the base layer. All right. In base layer, you have NBFCs which are not accepting deposits. That means if NBFC is accepting deposit, it can never be in base layer, because base layer is the least risky. Okay. So if NBFC is not accepting deposits and asset size is less than rupees 1000 crores, I repeat, so if asset size is 800 crores, but it is accepting deposits, then don't put it in base layer. So for base layer, it should not be accepting deposit. That is the first condition. And asset size is less than rupees 1000 crores. Then they have given different NBFCs: NBFC peer-to-peer lending platform, NBFC account aggregator, NBFC NOFHC, NBFC not accessing public funds and not having any customer interface. Now listen to me. You can pause this and you can actually see these practical examples. All right. If anyone wants to know what is peer-to-peer account aggregator and stuff, but peer-to-peer, it will create a platform whereby lenders and borrowers will come on one platform, peer-to-peer lending. Then account aggregator, it will not have any transaction with the customer. It will just pull the different accounts of the customer like equity, FDs, everything, and it will show it at one place. NOFHC, again to hold the banks. Okay. Not accessing public funds and not having any customer interface. That means if you understand, these NBFCs, they are the least risky. And that is the reason that they will always remain in the base layer. Sir, why you have written always base? That means even if their asset size is in top 10, does not make any difference. It will still remain always in the base layer. Am I clear with this? Yes. So if you zoom this, you will get more examples like for NOFHC and stuff. So such the small scribblings I have done. So in order to ensure that you understand. So I hope base layer is very clear. Pause it and see it 4 or 5 times. Okay. Next, middle layer. Middle layer, if NBFC is accepting deposits, irrespective of its asset size, it will never be base. That means it can either be in middle or upper, but it will never be in base. If NBFC is not accepting deposits and asset size is 1000 crore or more, asset size is 1000 crore or more, because less than 1000 crore is in base layer. So 1000 crore or more, middle layer. All right. Then NBFC standalone primary dealer. So who is a standalone primary dealer? Who can deal on his own with the government securities. They don't need any broker or something over there. So standalone primary dealer, IDF NBFC, These two will always remain in middle layer, always middle layer. All right. Core investment company, housing finance companies, infrastructure finance companies, never base. Students, even if I say this 10 times, still you will have to pause, see it for yourself for 2 minutes. All right. Only then you will understand. Okay. Yes, sir. Yes, sir. Otherwise, full super duper effort of the notes I have given over here. Now, listen to me. Upper layer NBFCs will be the NBFCs. Top 10 NBFCs based upon their asset size. Top 10 NBFCs based upon their asset size. But listen to me very carefully. Top 10 eligible NBFC. Sir, what do you mean by eligible NBFC? Please understand. Standalone primary dealer, IDF NBFC, it is always in middle. So it is not eligible for top, even though it is into top 10 asset size. Similarly, these are not eligible for top. I mean upper layer. Are you getting my point? They are not eligible for upper layer. So when I say upper layer, first of all, you need to be eligible NBFC. And that also, based upon your asset size, you need to be in top 10. Government owned NBFCs will never be in upper layer. That is what RBI has given. Top layer, currently it is empty until further notified by RBI. I hope I am clear with this. Yes, yes, all examples and material needed to understand is also given over here. Now comes the most interesting part, which is going on in a lot of YouTube channels, Telegram channels, everywhere. All right, that is net owned funds. Students, I have given one calculation of net owned funds over here. That is only for your understanding. All right, net owned fund full calculation you don't need to buy heart. Okay, because in module they have not given detailed calculation of net owned fund. Although they have given detailed calculation of tier 1 capital, which will come at a later stage, but they have not given detailed calculation of net owned fund. So net owned fund, you can just read the calculation. If you are in hurry, just move ahead. All right. Now, what is net owned fund requirement, which you need to understand? Listen to me very carefully. Net owned fund earlier was 2 crores. Now it has been revised to 10 crores. So from 1st October 2022 onwards, all right, they came up with new regulations. And then from 23, 24, 24, 25, they kept on revising. So in your exams, May 25 attempt onwards, new NBFCs requiring registration. If there is any point on new NBFC requiring registration, then general rule is 10 crores. Net owned fund for specialized NBFCs. For peer-to-peer account aggregator, NPF, NCI, that means not accessing public funds, not having any customer interface, nothing changes. All right, it will remain at 2 crores. But for NBFC, IDF and NBFC infrastructure finance company, net owned fund has been raised to 300 crores. Just get this snapshot in your mind. For students who know this, that these notes are more than enough. But still, this is a video just to help them run through. For all the existing NBFCs which were under the 2 crore regime, all right, for them, this is the path to be followed. All right. That from 2 crore, they have to go to 5 crore by 31st March 25, which can be an important point for May 25 attempt. All right. Then they have to go to 10 crore. All right. Microfinance institution, currently it was 5 crores, 2 crores in Northeast region, from there to 7, then 10. NBFC factors, all right. Then it is 5 crore. Okay. Then from there to 7, then 10 crore. All right. Relax, relax, relax. Okay. Now, whatever examples are required that I've given from Google over here. Now, next thing is prudential norms. Very, 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 very sensitive. Very, 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 very important because students are struggling with this. When I say prudential norms, means RBI guidelines for income, capital and non-performing asset provisioning. All right. First, let us talk about capital. Okay, everyone stay focused. There was one MTP question and which has created lots of trouble in the student circle. So everyone please focus. Okay. The requirement is that the capital of NBFC as given over here should be minimum 15% of some X amount. All right. Now this is what I need to teach. First, I will clear this part. Capital has to be 15% of X amounts. I need to explain this X. Okay. Now listen to me very carefully. What RBI has done, RBI has given weightage, all right, to different assets based upon the risk involved. So we have to do a simple calculation. Asset multiplied by risk weighted, risk percentage. All right, and you will get risk weighted assets. Okay, so this is for one asset, second asset, third asset, right? Similarly, you will get a summation of risk weighted assets. Okay, so we will finally understand that this is the risk that NBFC is carrying. This is how it is exposed. Now, below the balance sheet, after the balance sheet, there is something called as off balance sheet item, like bank guarantee and stuff. All right. So for all the off balance sheet items, they have also given one risk percentage. So it becomes risk adjusted value of off balance sheet item. All right. So both of this total, all right, is the X figure. Now 15% of X has to be minimum capital. Okay. So everyone over here, come on. Don't quit. This is very easy. So 15% of aggregate of risk weighted assets and risk adjusted value of off balance sheet items, all right, that should be your minimum capital, correct? So tier 1 plus tier 2 capital is equal to it. I mean, it should be greater than equal to 15% of aggregate of risk weighted assets and risk adjusted value of off balance sheet items. Now forget what is tier 1, tier 2 for 2 minutes. Just try to by heart. Tell me, tier 1 plus tier 2 capital has to be 50% or more of aggregate of risk weighted assets and risk adjusted value of off balance sheet items, correct? Okay. Now listen to me. From that, tier 1 capital has to be minimum 10%. I repeat, tier 1 capital has to be minimum 10%. 10% minimum, or that means 10% of this amount has to be tier 1 capital. Are you with me? 10% of this amount has to be tier 1 capital. But this is not applicable to NBFC microfinance institution and NBFC gold lending. Because for NBFC gold lending, all right, the minimum capital is 12%. For NBFC gold lending, the minimum tier 1 capital is 12%. 15% is general rule for everyone. For that, gold lending, tier 1 has to be 12%, all right? And for everyone else, tier 1 has to be 10%. Forget about NBFC microfinance institution. Module does not go in detail about that. Yes, sir. Okay. Now our job is very simple. We just need to calculate how to find out tier 1 capital, and then we need to calculate how to find out tier 2 capital. Tier 1 capital is simply, listen to me. A minus B plus C. Okay. A minus B plus C. Come on, tell me. A minus B plus C. Now, A figure is the owned fund figure. I repeat, A figure is the owned fund figure. All right. How to calculate that? Paid up equity capital, preference shares which are compulsorily into equity. See, please understand, tier 1 capital is a pure capital which is available for loss absorption capacity. So all pure capital thing you will find over here. Preference shares which are compulsorily into equity you will find in tier 1. But preference shares which are not compulsorily convertible into equity you will find in tier 2, because tier 2 is an impure capital. Are you getting my point? So paid up equity capital plus preference shares plus free reserves. You will not find all types of reserves. Plus share premium account. Plus capital reserves representing surplus on sale of assets, but no revaluation reserve. All right. That is your A figure. A minus B plus C. What is going to be subtracted? All right. See, we are finding tier 1 capital which is available for loss absorption capacity. If I have already invested funds in other NBFCs, in my group companies, in my subsidiaries, then I've already invested that. So I need to minus it. So minus investment in shares of other NBFC. See, owned fund full calculation I did not give. Minus accumulated losses, minus intangible, minus deferred revenue expenditure. I went little fast in that because the calculation is in front of you and this is very simple. All right. So that is your owned fund. You have calculated this equity fund and shareholders fund also here. Okay. Now listen to me. What you are going to subtract. Focus over here very carefully. Investment in shares of other NBFC, investment, loans, deposits in subsidiaries and companies in the same group. All right. If this entire figure is more than 10% of the owned fund, then whatever is more than 10% of the owned fund, that much only you will subtract. Sir, can you please explain? If owned fund is 100, all right, and this figure is 20, okay, then what is 10% of 100? 10. Okay, then you will do 100 minus 10 because it is only exceeding 10%. Only that 10 rupees is exceeding 10% of the owned fund. All right. Yes, sir. Then A minus B plus C. What is this plus C? perpetual debt instruments issued by non-deposit taking NBFC, only for non-deposit taking NBFC, perpetual debt instruments irredeemable in each year to the extent it does not exceed 15% of aggregate of tier 1 capital of such company as on March 31 of previous accounting year. Very simple, listen to me. Alright, so first of all, we'll talk about non-deposit taking NBFC. Only there you have to add this plus C. Okay. Now, whatever are the perpetual debt instruments? Let us say perpetual debt instruments, alright, are 900 rupees. Okay. But previous accounting year, tier 1 capital, alright, let us say it is 5,000. Okay. Now, what is 10% of 5,000? That is your 500. Alright. And then, 10% of 5,000. Yeah. That is going to be your 500. Okay. And then 15% of that will be your 750. So, only 750 rupees perpetual debt instruments are allowed to be included. Because it will be 15% of tier 1 capital of the previous accounting year. I want a confirmation. Are you understanding this? Yes or no, sir? Yes, sir. Yes, sir. Yes, sir. Alright. That is as simple as that. Very, very simple calculation. So one more time, A minus B plus C. A owned fund minus whatever are the investments in other NBFC shares and subsidiaries of our own shares in the subsidiaries, loans made to investments made in the group companies. Alright. All of that I am going to minus only to the extent it is exceeding 10% of the owned fund. Alright. Plus I will add perpetual debt instruments, but only to the extent which is 15%, maximum 15% of the tier 1 capital of the previous year. So A minus B plus C. Just pause this video and revise it 2-3 times so that you don't forget. Then my dear friends, straight away, you can go to the last page of this particular PDF. Alright. Where I have given this entire question on tier 1 and tier 2 capital. You see this mock test paper question, computation of tier 1 capital. They have given owned fund minus investment in group entities plus eligible perpetual debt instruments. Alright, A minus B plus C, you will clearly see over there. Alright, for this perpetual debt instruments, previous accounting year tier 1 capital is not given. So they have assumed that entire 120 crore qualifies. They have assumed that it is limited to 15% of the previous year's tier 1 capital. Alright, owned fund figure they have given, investments in the group entities also they have given over here. And in investment in group entities, they themselves give you the figure about that was whatever is the figure exceeding 10% of the owned fund, that figure was given by them. So it is very simple. Please do not complicate. Alright. Yes, sir. Yes, sir. Yes, sir. Now we talk about tier 2 capital. Okay. So tier 2 capital, they are saying that it is a sum of and then 1, 2, 3, 4, 5, 6. Okay. But let us understand it. It is an impure capital. Preference shares which are not compulsory into equity, because compulsory equity was there in tier 1. Revaluation reserves at discounted rate of 55%. Alright. Over here, mock test paper has done something that they have discounted it by 55%. That means 45% is allowed. Okay, look at this. Tier 2 capital. They have given preference shares 80 crores. However, revaluation reserve, tier 1 though it is not allowed. And 200 crores, they have considered only 55% they have subtracted and they have considered it 90 crores. As you can see over here. Yes. So please be very, very careful, my dear friend, for tier 1 and tier 2 capital. Okay. We go back. Tier 2 capital, revaluation reserves at discounted rate of 55%. Then whatever are the general provisions and loss reserves, but only to the extent of 1.25% of risk-weighted assets. Again, you can go back to the sum. They have given risk-weighted assets and they have calculated 1.25%. I think in that sum, risk-weighted assets, it's 8,000 crores. So 1.25%. All right. Whatever figure it comes to, I think it's 100 crore. But anyways, general provisions and loss reserves are less than that. So there should not be a very big problem over there. All right. Then hybrid debt capital instruments, subordinated debt, and perpetual debt instruments, whatever was not included in tier 1. See, in tier 1, you had included only to the extent of 15% of previous tier 1's capital. So whatever is the balancing figure of perpetual debt instrument which was not included in tier 1, that you are going to include in tier 2. Now listen to me very carefully. The golden rule in tier 2 capital. The golden rule in tier 2 capital. 1 plus 2 plus 3 plus 4 plus 5 plus 6. Whatever is the figure, it should not exceed tier 1. That means if tier 1 capital is 1000 crores, alright, and tier 2 capital becomes 2000 crores, then you will include only to the extent of tier 1. Then you will restrict tier 2 figure till 1000 crores. So in under any circumstances, tier 2 cannot exceed tier 1. Am I clear with this? Yes, sir. Yes, sir. Yes, sir. Now listen to me very, very carefully. One special note for NBFCs which are in the base layer. One special note for NBFCs which are in the base layer. For base layer NBFCs, whether you talk about tier 1 or tier 2, they will not be allowed to include perpetual debt instruments, neither in tier 1 nor in tier 2. So my humble request, please pause this video, look at this calculation 2-3 times, all right? Go to the end, see that mock test paper question again, and I think it should not be a very big problem for you. Am I clear with this? Yes, sir. Yes, sir. Yes, sir. All right. So we are done with tier 1, tier 2 capital discussion also. Now listen to me very carefully. Income recognition and asset provisioning. I'm assuming the students have little bit knowledge of non-performing assets over here. So I'm straight away coming to the NBFC discussion. But still, you will understand it from the scratch. So if it is a loan of rupees 100 and interest accrued but not realized is rupees 10. Once this loan is declared as NPA, then there will be some percentage provision on the amount of asset, which is as per RBI classification, which I will show you. But this 10 rupees will be fully reversed. Once this loan is classified as NPA, this 10 rupees will be fully reversed and there will be percentage provision on the amount of asset as per RBI classification. All right. That is exactly the classification which I'm going to teach now. Everyone, please be super careful. Asset classification. Now listen to me. Before this layers, base layer, middle layer, upper layer, everything was announced. All right. Before scale-based regulations, all right, this NPA norms asset classification, they were applicable in this manner. Sir, why this knowledge is necessary? Necessary, please understand. Truly it is necessary. Before scale-based regulations, that means in the old NBFC chapter, for NBFC accepting deposits and for NBFC not accepting deposits but systemically important. Systemically important NBFCs are NBFCs whose asset size is 500 crores or more. For these NBFCs, they were treated like banks and the rule was overdue for a period of more than 90 days. So if the installment remains overdue for a period of more than 90 days, you classify it as NPA, as simple as that. And let me tell you, even after scale-based regulations, all right, even after scale-based regulations, this remains unchanged. This remains unchanged. So if it is NBFC D, NBFC not accepting deposits, systemically important. Earlier, they were classifying it based upon more than 90 days. If installment remains overdue more than 90 days, it is NPA. It remains unchanged. However, for NBFC ND NSI, that means not accepting deposits, non-systemically important, the earlier period was overdue for a period of more than 180 days. Overdue for a period of more than 180 days. All right. That is the reason. And now, they also need to follow overdue more than 90 days. But that slowly, steadily, they have to follow. By 31st March 24, it is more than 150 days overdue. By 31st March 25, is more than 120 days overdue, and slowly, steadily, they will reach more than 90 days overdue. So I think this figure becomes very, very important for May 25 exams. Later on, from May 26 onwards and stuff, more than 90 days, all right, is for common for all. So it will become very simple later on. Yes, sir. Yes, sir. See, they have clearly given the glide path will not be applicable to NBFCs which are already required to follow the 90-day norm. So this continues as it is. Am I clear with this? Yes, yes, sir. All right. Chalo. Now everyone over here. Asset classification and provisioning. Provisioning. Please. I already told you NPA. That when an asset will be classified as NPA. Now I am teaching provisioning. All right. Provisioning will depend upon asset classification. Asset is classified into substandard, doubtful loss. Correct? Okay. So everyone, standard, substandard, doubtful loss. Now we have divided into two parts. For NBFC base layer and then for NBFC middle layer and above. For NBFC middle layer and above, standard, see, they are treated almost like banks here. All right. So standard asset 0.4% provision. For NBFC base layer, standard asset 0.25% provision. All right. Now over here, middle layer and above, first it is like banks, I will finish it off. For middle layer and above, standard asset 0.4% provision. If it becomes NPA, NPA up to 12 months is substandard. Beyond 12 months, then doubtful up to 1 year, 1 to 3 years, more than 3 years. Correct? Similarly, for base layer, standard asset provision is 0.25%. If it becomes NPA, only one thing you have to remember, NPA up to 18 months, it remains in substandard category. So normally for middle layer and above, NPA up to 12 months remains in substandard category. And for base layer, NPA up to 18 months remains in substandard category. Above 18 months, it moves into doubtful. After that, it becomes similar. That means doubtful up to 1 year, doubtful 1 to 3 years, more than 3 years. For middle layer, base layer, upper layer, for everyone, that is same. However, substandard asset definition is different. So for middle layer and above, substandard will be NP up to 12 months. And for base layer, it will be NP up to 18 months. Am I clear with this? Yes, yes. Now, percentage provisioning. Relax. Standard asset percentage provisioning is different. For middle layer, it is 0.4%. For base layer, it is 0.25%. However, for substandard, it is 10% over here. Substandard, 10% over here. Not an issue at all. Doubtful, unsecured. If you get doubtful, unsecured, no matter whichever NBFC it is, just write 100% provision on the amount of assets. However, if you get doubtful, secured, all right, then D1, D2, D3, 20, 30, 50. Come on, tell me. 20 plus 30, 50. Similarly, you can remember easily. All right, 20, 30, 50. 20, 30, 50. Yes, sir. Yes, sir. Yes, sir. Okay. Students, let me tell you, there are lots of things as per RBI circular which I can teach over here. But I'm restricting myself to the things that are given in the module so that you are very clear, all right, when you are going for your exams. Okay. Now, done. Prudential norms discussion is over. My humble request, please put this video on pause, all right. Just see this capital asset provisioning one more time, all right, so that you are relaxed. Okay, finally, these are the points that you are going to follow. Chalo. Now, moving ahead in our discussion. Auditors reporting duty. This is very simple. Please, please, please stay focused. This is an additional reporting requirement. You are already preparing audit report. In addition to that, you are supposed to prepare a separate report which will be placed in front of board of directors. All right. Special adjustment. In this report which will be placed in front of board of directors, these are the matters upon which you need to conduct inquiry. Total around 21 matters depending on different NBFCs. All right. And these matters are given in RBI Master Directions 2024. However, special adjustment. This is an internal report to the board of directors. However, in any of these matters, if there is a negative remark, that means there is an exception in any of these matters, then in that case, you will have to send a separate report to Department of Non-Banking Supervision of RBI. Please remember this. This is a very special adjustment. Okay. Now listen to me very, 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 very carefully. In case of all NBFCs, there are 3 inquiries. Don't by heart everything. These 3 inquiries, just broadly remember, are with respect to registration, all right, registration and net owned funds. Okay. Listen to me. What will be the impact? This is a very important case study from the module. So tell me, first point, all right, we have to find out NBFC by 50-50 rule. So what if financial assets are more than 50% of total assets netted off by intangible assets, and income from financial asset is more than 50% of the gross income? If it fulfills both the criteria, then it needs to obtain registration from RBI. What if the company has not obtained registration from RBI? One thing, negative remark in Caro clause 16A. Second, all right, there will be an exception report will be submitted to RBI because this inquiry we are supposed to conduct. So normally this adjustment everyone forgets. People only remember Caro clause 16. That is why they lose marks. All right. Yes, sir. Yes, sir. Then in case of NBFCs which are accepting public deposits, there are about 12 clauses. Obviously, you cannot by heart these 12 clauses. I will just give you a summary. So these 12 clauses they deal with that if NBFC is accepting public deposits, then there is a minimum credit rating. All right. then only based upon that credit rating they can accept public deposits. So the major inquiry is all about credit rating, whether it has obtained credit rating, whether it is fulfilling the criteria, whether the deposits accepted are within the limits of the credit rating. So you cannot by heart everything. You can just glance once, that's it. Okay, don't try to find too many meanings. Then this is a very new addition in the module, that statutory auditor has to sign one compliance certificate, which is to be submitted to RBI that yes, the company has obtained certificate of registration and it is fulfilling net owned fund requirement. It is to be submitted to RBI within 5 working days from the date of auditor's report, but the last date of submission is 31st December. So within 5 working days from the date of auditor's report or 31st December, whichever is earlier. Yes. For NBFCs not accepting public deposits, there are around 5 clauses, which again state that whether the company has accepted public deposits, whether the board of directors have passed a resolution for not accepting public deposits, or whether company is complying with RBI regulations, capital regulations, prudential norms, all of that. Okay. And then for NBFC, which is exempt, they are just inquiring whether it fulfills the criteria of exemption or not. All right. So you can see it very clear over here. My notes are also very clear. The concept is also very clear. Just that this you should remember. If there is a negative mark, needs to be reported to RBI. Yes, sir. Yes, sir. Yes, sir. Okay. Moving ahead. Then there are some discussions on audit procedures. For this, only few important adjustments. For audit procedures for NBFCs which are accepting public deposits. I repeat, for NBFCs which are accepting public deposits. Okay. There they are discussing about check whether the credit rating has been obtained or not. And what if the NBFC's credit rating is downgraded? What if it reaches below the minimum investment grade? Minimum investment grade is the basic credit rating which is required to start accepting public deposits. If it reaches below minimum investment grade, and this has been their examination question, they need to immediately stop accepting fresh deposits and renewal of existing deposits. All existing deposits will run only up to the maturity. All right, and they need to report the position within 15 working days to RBI if the credit rating is downgraded below the minimum investment grade. Then if they ask you audit procedures on NBFC prudential norms, just write whether minimum capital has been maintained, whether asset provision has been done as per substandard doubtful loss, whether board of directors have passed a resolution or there is an internal policy for prudential norms. Just general checklist for prudential norms, capital, income, asset. Then if they ask you NBFC, ICC, there are about 16 points which they have given. ICC is investment and credit company. So whenever someone gives investments, loans, all right, internal controls, RBI compliance, lots of points that you can write over here. You will be allowed to write on your own over there, general audit checklist. Okay. Other points, there is one paragraph on classification of fraud by NBFC, which is again as per RBI guidelines. What is the fraud, how it needs to be reported, all of that is not given. They have just given classification of fraud by NBFC. I have also created one code word and you can by heart this. All right. However, there is one adjustment. Fraud regarding cash shortage needs to be reported to RBI. So what is cash shortage? Suspense account. So books of accounts and actual cash not tallying. So cash shortage will be reported to RBI if it is more than 10,000 daily basis, more than 10,000 reported. For cases up to rupees 5,000, not applicable. For cases 5,001 to 10,000 means more than 5,000 up to 10,000. If it is already internally reported by cashier to the top management, then this requirement is not applicable. However, cashier did not report it to the top management, then you please report it to RBI. All right. So then again, there can be an adjustment over here. Yes, sir. Yes, sir. Then one of their favorite, all right, is NBFC financial statements, which is the last test your understanding question also in the module, which I would recommend you to see. All right, NBFC financial statements versus Schedule 3 Ind AS. Okay. So Schedule 3, Division 2 and Division 3 basically. All right. So there they have given these differences. You are much more qualified than me after FR paper to understand these differences. So I would request you to just go through this once. If there is any doubt, obviously you can type in the comment box and I'll be very happy to reply. And couple of LDR questions which are related to calculation which I have given over here. Otherwise, my recommendation is that at least the behind it test your knowledge questions. All right. The few case studies which I have printed over here. Yes. Question 8, 9 and 10. These case studies at least you should solve. All right. So I think this will be more than enough practice. All right, for the topic of NBFC. I have tried my level best to cover it within 40 minutes to boost your confidence. Keep following this space. I'm coming up with lot many things as much as God can strengthen me. All right, to help you out. I am trying my level best. All right. Thank you so much. All the best.